welcome to episode 34 of the Special Situations Report, a podcast by Inside Arbitrage covering the most intriguing event-driven activity over the past week. My name is Asif Suria, and I'm coming to you from the beautiful San Francisco Bay Area.
And my name is Tamanna Suria, and I currently attend the University of California, Los Angeles.
What we will cover in the podcast today is just a small part of what happened in the special situations world last week. For daily updates and alerts on the special situations world, as well as access to tools to help you identify opportunities, such as our merger arbitrage tool, check out insidearbitrage.com.
We're trying out a bit of a different style for today's podcast, where we'll discuss 4 key stories, including a potential bidding war for Canada Goose, a flip-flopping insider at a pediatric orthopedic company, a unique buyback at a Bitcoin treasury company, and a C-suite transition at everyone's favorite footwear brand, Crocs. Now, before we begin, we want to state that nothing on this podcast is meant as investment advice. Please refer to our disclaimer at the end of this podcast for more detail.
And take a moment to like or subscribe to this podcast on any platform you might be listening on. We're going to kick off this episode with a rumored deal, or as we like to call it, a deal in the works. Most investors have learned the hard way to avoid investing in apparel companies, and especially those that operate a chain of brick and mortar stores. In some sense, I felt like I've learned that lesson over and over again. Inevitably, a vast majority of them fall prey to changing fashion trends or a flash-in-the-pan fad that fades rapidly. We wanted to start this episode by discussing one of these companies which makes luxury winter wear. Canada Goose, which used to be called Snow Goose, surged in popularity during the last decade after it was seen in movies like The National Treasure and following celebrity endorsements. The company went public in 2017 and the stock peaked at just over $70 per share in late 2018. And it currently trades at about $13 per share, which is lower than where it was trading during the pandemic lows.
I mean, to be fair, the current price of around $13 per share is better than where the company was trading at just a few months ago.
Yeah, you make a good point. The current price is actually nearly double where it was trading during the April tariff fears, when it had dipped to the $6 territory. This goes to show how far the stock and maybe even the brand has fallen since its glory days in the middle of the last decade.
But wasn't the footwear company Crocs also considered a fad at one point?
Yes, one of the things that has held back the stock of Crocs and the extreme volatility the stock has experienced can be traced back to investors assuming for the better part of a decade that the ugly-looking clogs were a fad and would eventually fade. I want to be clear that I don't necessarily consider it as ugly-looking clogs, and I own a pair myself, but that seems to be the general consensus. I would argue that in some sense, both Canada Goose and Crocs have proved to be more resilient than investors have given them credit for. And incidentally, while both companies price their products at the exact opposite ends of the consumer price spectrum, investors have put both companies in the bargain bin, and they trade at just 6 times trading free cash flow.
Wow.
Getting back to the performance of Canada Goose's stock, it surged 16% in a single day last week after CNBC reported that the company had attracted bids from private equity firms, hoping to acquire it at a market value of approximately $1.35 billion. That's about 7% above where the stock is currently trading. To go back a little bit on what's happened with the company, Bain Capital acquired a majority stake in Canada Goose in 2013 and has been a controlling shareholder through a special class of shares that gives it 10 votes per share compared to common stock. If you remember last week, we were talking about the Dallas News acquisition and how a controlling shareholders that has 10 votes per share is not allowing a higher deal price to go through. This structure with Canada Goose gives Bain Capital 55.5% of the company's total voting power, and Bain has retained Goldman Sachs to help it strike a deal for Canada Goose. Incidentally, Canada Goose is also presenting at the Goldman Sachs annual retailing conference on Tuesday of this week, so we might see some news come out of the conference, or investors might be disappointed that they didn't get the news they were looking for and the stock might pull back a bit. That said, private equity firms such as Boyu Capital and Advent International have expressed interest in acquiring the company from Bain. The other interested buyers include Bosi Deng International, a Shanghai-based maker of down jackets, which makes a lot of sense considering that's kind of what Canada Goose does as well, and a consortium formed by a private equity firm, Fountain West Capital, and Hong Kong-listed sportswear maker Anta Sports Products. Fountain West and Anta Sports had previously acquired Amer Sports, which was the owner of Wilson tennis rackets.
This situation reminds me a lot of Guess, which we covered on our last podcast, especially with the number of bids coming in. If you remember, Guess had bids from Authentic Brands Group, which was a consortium of different brands that they had acquired out of bankruptcy over the last couple of years. And they also had a bid from WHP Global.
Yeah, so many parallels with the last episode. We just talked about the multi-vote special class of shares. And you're right, Guess was a deals in the works situation that we covered in our April 2025 monthly special situations newsletter. WHP Global offered $13 per share for Guess, but it was Authentic Brands that eventually struck a deal for Guess at $16.75 per share. The deal was interesting because Authentic Brands was buying a 51% stake in the intellectual property, including the Guess brand. And the founders of Guess, along with the CEO, will continue to own the other 49%, and they will continue to operate the Guess stores. So basically the $16.75 per share is for the common shareholders that will not be rolling over their stock into the new company like the founders of Guess and the CEO are doing. Getting back to Authentic Brands Group, it is best known for acquiring brands such as Reebok, Forever 21, Nautica, Champion, Eddie Bauer, and more. WHP Global is also a brand aggregator that owns Anne Klein, Isaac Mizrahi, Bonobos, Joseph Abboud, as well as a stake in Rag & Bone, which is in partnership with Guess. So that is interesting, right? So WHP Global had worked with Guess to acquire Rag & Bone, and they made the first offer, but it was Authentic Brand that came out winner in that bidding war. So in that sense, Guess management did the right thing for minority shareholders when compared to the Dallas News situation we were talking about the last few weeks. I believe both WHP and Authentic Brands can be an excellent home for Canada Goose, especially if these two brand aggregators want to move upstream with their brand portfolio. Given how much Authentic paid for the 51% stake in Guess's IP, I think a Canada Goose deal could represent upside of anywhere from 30 to 50% from current levels.
So you mentioned that both WHP Global and Authentic Brands could be a good home for Canada Goose. Do you have any idea as to why it's been mainly private equity firms making bids for Canada Goose? Is it just to keep it in the private equity ecosystem? Or why are there not more of these brand aggregators coming in and making bids for the business?
Yeah, that's a very good question. In some sense, there's a lot of money in private equity at this point. Sure, we're not in the zero interest rate environment, but these companies have grown quite a bit and private equity has a lot of money to deploy. That's one reason. The other reason is there aren't that many large brand aggregators like WHP Global or Authentic Brands. They're very unique in the sense, like, I think Authentic Brands has over 50 brands in its portfolio and they generate billions of dollars in sales. So they started out buying companies in bankruptcy. And what you're seeing them do with Guess is they're moving a little bit more upmarket. They're not waiting for brands to show up in bankruptcy. They're buying a company like Guess, which wasn't distressed. And so if they were to continue down that playbook, I can see Canada Goose being a good fit for them. But that said, these situations are always uncertain and there's no guarantee that a deal might actually happen or at the currently contemplated prices. I've also seen situations where the deal did come to fruition, but it was structured as an all-stock deal that provided little upside. That said, this has been an attractive area for us, and we do an annual update on deals in the works situations, looking back at the outcomes of hundreds of rumored deals or potential deals and any signals that could help us improve our batting average in this area.
Moving on to the insider section of this podcast, every few weeks we come across a transaction from a flip-flopping insider, or an insider that violates the short swing profit rule.
For investors that might not be familiar with both these interesting terms, a flip-flopping insider or the short swing profit rule, can you elaborate a little bit on what that means?
Yeah, of course. So the SEC does not want insiders to engage in short-term trading, and thus requires them to give back any profits from conflicting trades that happened within a 6-month period. This is what's called the short swing profit rule. Now, there's a more formal definition to it, and that's that Section 16B of the Securities Exchange Act of 1934 states that if an insider of a public company buys and sells, or on the other hand, sells and buys, stock of the company within a 6-month period, they have to disgorge profits from those matching trades back to the company.
That's a mouthful.
That it is. The rule is used to discourage insiders from using the information they possess to make short-term profits. Now, every once in a while, we come across insider transactions where the insider has indicated that the transaction in fact violates the short swing profit rule, and that they will return any profits from the prior trade back to the company. We call them flip-flopping insiders because they've kind of flip-flopped on their decision there, and we think that they are sending us a signal that the prevailing winds have changed and that they are willing to give up some short-term profits to make even more money down the road. This week, we came across a unique flip-flopping insider transaction at an equally unique company, OrthoPediatrics, the only global medical device company focused exclusively on providing comprehensive trauma and deformity correction, scoliosis, and sports medicine product offerings to the pediatric orthopedic market.
Oh, that's fascinating. And I remember looking at their logo and it's so cute. Can you tell us a little bit more about what pediatric orthopedics does?
Exactly. So historically, there have been a very limited number of implants and instruments specifically designed for the unique needs of children. And as a result, pediatric orthopedic surgeons, that has to do with mainly matters of the spine, often improvise with adult implants repurposed for use in children. They resort to freehand techniques with adult instruments, and they use implants that can be difficult to remove after being temporarily implanted. And these improvisations can lead to undue surgical trauma and morbidity. OrthoPediatrics solves for this by essentially creating medical devices for the exclusive use in the pediatric orthopedic markets. The company has been growing revenue and expanding market share both organically and through acquisitions. And quite frankly, they seem to have negotiated wonderful prices for these acquisitions. In early 2024, they acquired Boston Orthotics and Prosthetics, otherwise known as Boston O&P, for just $22 million upfront in cash.
As someone who was involved in healthcare services in the past, I have to say that the $22 million price for that business looks like a steal. I wonder if that is just the upfront price and what, if any, the earnouts were related to that deal.
Yeah, unfortunately, the only information disclosed was that upfront $22 million cash payment. Boston O&P was a profitable leader in the pediatric orthotic management market for over 50 years, and the company was doing $25 million in revenue. And that's why that $22 million price seems so low. The company also pioneered some of the most individualized and advanced braces for the treatment of orthopedic conditions in children. Boston O&P also owned and operated 26 pediatric-focused O&P clinics across 10 states, all of which OrthoPediatrics also took over. When it comes to the financial side of things, OrthoPediatrics has been very consistently growing revenue year after year, but the company is struggling with turning a consistent profit. The company recently reported Q2 2025 results, where they recorded a new high total revenue of $61.1 million, up 16% from the $52.8 million recorded in revenue in Q2 2024. But unfortunately, net loss for the quarter grew to $7.1 million, as opposed to $6 million in the same period last year.
I've seen a lot of companies like this where they inflect to profitability and the stock takes off like a rocket. We don't know if that's going to happen here, if they're going to grow out of the way from those losses and eventually become a profitable business. But why else are we so interested in this company at this point?
Yeah, so that ties back to the flip-flopper topic we discussed earlier. This week, we saw the COO and CFO of OrthoPediatrics, Fred Hite, purchase nearly $100,000 worth of stock after selling roughly $160,000 worth of stock at a much higher price back in March 2025. Due to the transaction violating the short swing profit rule, Mr. Hite disclosed in the footnotes of his Form 4 filing that he disgorged about $27 worth of profit back to the company, and again, that represents the full amount of profit realized in connection with the flip-flopping transaction. But the strange thing about Mr. Hite's initial sale was that it wasn't really a sale in the traditional sense of the word in the first place. Looking at the footnotes of the Form 4 filing from March, the sale is accompanied by a note that states it was executed in order to satisfy tax withholding obligations upon the vesting of restricted shares. However, a form code already exists for this type of transaction, and that's distinct from a sale. If the sale is in connection with the vesting of RSUs or restricted stock units, as was the case for Mr. Height's March sale, then you can record that as an F, not an S, and it won't be recorded as a technical sale.
Yeah, I've seen this mistake made quite often. And if you notice the Form 4 filings coming in every weekend or every day, the insiders of Palantir keep filing with the code S instead of F for their tax related sales.
Yeah, it's a quite interesting phenomenon that's surprisingly very common. So while this transaction by Mr. Height himself isn't a full flip-flopping transaction in the sense that he wasn't bearish about the stock and then suddenly changed his mind, the rationale behind paying attention to flip-flopping transactions remains the same. Despite needing to pay an additional fee in some sense to purchase these shares, Mr. Height appears bullish enough to grow his position in OrthoPediatrics at this price.
As you and I know, we've realized over time that paying attention to the actual insider is just as important as understanding what the company does and if it is positioned well to do well. So tell us a little bit about Fred Height and what has he done in the past? What's so interesting about him?
Fred Height joined OrthoPediatrics as CFO in 2015 and navigated the company through its October 2017 IPO, and then took on the additional role of COO in 2020. Prior to joining OrthoPediatrics, Mr. Height spent over 10 years as a CFO of Symmetry Medical. Now, before Symmetry Medical, Mr. Height spent 13 years with General Electric, or GE, during the Jack Welch era in a variety of finance-related positions. This is his first time ever purchasing shares of OrthoPediatrics, after having only sold shares consistently since the company's IPO. Granted, most of these earlier sales are related to the vesting of stock units, but a first-time buy an insider is another positive signal that we tend to look out for. So the combination of a semi-flip-flopper and a first-time buyer has undoubtedly gotten us interested in the business. While OrthoPediatrics' financials still have quite a way to go, Mr. Height's purchase might suggest that the prevailing winds are changing, and that he's willing to pay a small fee for a chance at a much larger gain down the road. That too, with companies like Stryker being highly acquisitive in recent years, we saw their acquisition of Inari Medical at the start of this year, OrthoPediatrics could also be a good tuck-in acquisition for a company like Stryker or another medical devices company like Medtronic.
Yeah, the other interesting thing about this whole situation is they don't always state in the footnotes that this is a flip-flopper transaction and they had to pay some profits back. We have to actually look at it from a screen that we built to see if there was a flip-flopper situation. So we do read the footnotes, find them that way, but there are other ways of finding these flip-flopper situations. Switching gears to stock buybacks, over the last few weeks, we have mentioned a few crypto treasury companies on this podcast. What are crypto treasury companies? Just like MicroStrategy, which is now called Strategy, decided to become a Bitcoin treasury company by not just holding Bitcoin on its balance sheet, but also raising additional cash through secondary offerings to buy even more Bitcoin. There have been several companies like Upexi that have pivoted to becoming crypto treasury companies. For example, Upexi holds Solana on its balance sheet. Bitmine uses Bitcoin, like Strategy does, for their treasury holding on the balance sheet, and SharpLink holds Ethereum. When I noticed that SharpLink announced a $1.5 billion buyback representing 42% of the company's market cap at announcement, I was quite surprised. This announcement was similar to Bitmine, which also announced a $1 billion buyback, representing 28% of that company's market cap at announcement.
So very often we see these kinds of large buybacks from a wide variety of companies, and then some of them also follow through on these announcements with actual buybacks, including large cannibals like the home builder NVR. So what surprised you about these types of companies, these crypto treasury companies buying back stock in particular?
Yeah, what makes this situation surprising to me is the paradoxical use of massive share repurchase programs alongside aggressive equity raises for crypto accumulation. And I'm not saying that these companies have started buying back stock, they've just made an announcement. For example, Michael Saylor of Strategy has shocked rational observers by continuously raising more capital through convertible notes, preferred stock, and even at the money offerings of common stock. At times, the company was trading at nearly twice the net asset value or NAV of its Bitcoin holdings on the balance sheet. And in other instances, the interest offered on its convertible notes was next to nothing. Getting back to SharpLink, this was a niche online betting provider that saw its stock jump from under $3 per share to over $100 per share after it announced that it's pivoting to a crypto treasury company. The stock gave back a large part of those momentary gains and now trades at almost $18 per share. So while it has come down from that peak, it's still up significantly before it became this crypto treasury company.
Yeah, I think we've seen a lot of crypto treasury companies announce that they are a crypto treasury company and then the stock just skyrockets from there. Wasn't there a biotech or a medical devices company that recently announced the switch to being a crypto treasury company? And that was unique because I'd never seen a company in the medical sphere or the healthcare sphere turn into a crypto treasury company. And there was another situation recently where the crypto treasury company announced that it had become a crypto treasury company, and we saw a series of insider transactions at the company where directors suddenly bought and then immediately sold shares after the stock had skyrocketed, not realizing that that transaction violated the flip-flopper or short swing profit rule that we talked about earlier, right?
That's exactly right. He did not realize it was a flip-flopping transaction, and he bought 40,000 shares, if I remember correctly, and then he sold 20,000 immediately the day after, and then gave back a bunch of those gains because the stock skyrocketed when they announced they were going to be a crypto treasury company. So while you were talking about the orthopedics company, the medical device company, I was reminded of that other medical devices company that ended up pivoting and becoming a crypto treasury company. So I understand that these kind of companies issue common stock, preferred shares, or convertible debt to raise even more fiat money, as they like to call it. But why would they suddenly announce stock buybacks instead? Reading through their press release, they make it quite clear that they're creating the buyback program to give them flexibility to buy back their stock in case it trades below the NAV of its Ethereum holdings. The whole dynamic is shocking to me. In many ways, all these companies are creating demand for the underlying crypto of their choice, whether it is Solana, Ethereum, or Bitcoin. And then on the other side, if the fevered enthusiasm for the cryptocurrency trades fades, they want the ability to be able to prop up their stock through these buybacks. This really reinforces our theory that we are very much in a massive bubble with renewed fervor for SPACs, crypto treasury companies going to the moon, and AI companies trading at insane valuations. All that said, this whole strategy of issuing a bunch of stock and then also putting in a buyback program in place to support the stock if it drops is diabolically brilliant.
Diabolically brilliant is a great way to put it. We'll wrap up this podcast with a look at C-suite transitions. This week, we saw the sudden departure of the footwear company's Crocs CFO, Susan Healy. There's been a number of C-suite transitions at the company over the last 2 years. In fact, Miss Healy only joined the business as CFO in June 2024, so a little over a year ago. This departure also follows Crocs EVP and Chief Digital Officer deciding to retire in May of this year. To replace Miss Healy, Crocs appointed Patrick Reagan to the position of EVP and CFO. Mr. Reagan was most recently the Chief Financial Officer at Shark Ninja, the household and kitchen appliances business. He joined Shark Ninja in April 2024, and since then, the company's stock price has appreciated by around 87%.
Yeah, I was looking at Shark Ninja not too long ago, and it's an amazing business. They seem to price themselves somewhere between the Dysons of the world and the Hamilton Beach or the bottom end. They're closer to Dyson, if you will, in terms of their pricing, and they've done very well. But this whole situation is very odd, isn't it? Why would a footwear company like Crocs appoint someone from an appliance business?
Honestly, that was my first question as well. But looking a bit further into Mr. Reagan, prior to joining Shark Ninja, he spent approximately 14 years at one of the largest footwear companies in the world, Nike. And at Nike, he climbed the ranks to become CFO of the Asian and Latin American business divisions. And at the end of the day, Crocs is a consumer products company. And Mr. Reagan's experience is heavily tied to the consumer products industry, not just with Shark Ninja and Nike. He's also held finance positions and director roles at businesses such as Kraft Foods, Polo Ralph Lauren, and Coach. Now, unlike Shark Ninja, Crocs stock has dropped by 37% in the last year, and following a nearly 20% drop in a single day at the start of this month, we saw a couple insiders purchase shares, including a director and the former CFO, Susan Healy. So she was buying shares at the start of this month and then suddenly decided to resign at the end of this month.
Yeah, Crocs has had a difficult time over the last few years, and I can see why that could have prompted her departure. But that was a very significant drop in the stock price recently. What caused this sudden drop?
I mean, it's a tale as old as time, as is the case for most companies. Whenever you post weak financial results and or weak outlook and guidance for the upcoming quarter, your stock tends to plummet quite quickly because the market is a punishing force. Crocs reported Q2 2025 results at the start of this month, and despite revenue growing 3.4% year over year to $1.14 billion for the quarter, Crocs had to take a large impairment related to the Hey Dude brand, totaling $737 million. This created an operating loss of $428 million for the quarter, as compared to operating income of $326 million for Q2 2024. As for Q3 2025 guidance, the company expected revenues to be down approximately 11 to 9% compared to the third quarter of 2024, and an adjusted operating margin of between 18% to 19%. And that's primarily due to the anticipated negative impacts of announced or pending tariffs. Bear in mind, during Q2 2025, the company reported an adjusted operating margin of 26.9%. So this is quite a hit to the income statement. Despite it all, Crocs seems to be managing its balance sheet quite well. During the quarter, the company managed to repay $105 million of debt and return value to shareholders by repurchasing approximately 1.3 million shares for a total of $133 million at an average price of $102 roughly. At quarter end, approximately $1.1 billion of share repurchase authorization remained available for future repurchases as well.
I know the company had taken a pretty big hit in the last few quarters since the Hey Dude acquisition because the brand was weak compared to the core Crocs brand. But quite frankly, that 9% to 11% decline in revenue for the next quarter is quite shocking to me. I didn't realize as a whole company they were reporting such significant decline in revenue. But how has the Hey Dude brand been faring recently?
So Crocs completed its acquisition of Hey Dude in February 2022 in a cash and stock deal valued around $2.5 billion. However, the acquisition, as you mentioned, doesn't look to have turned out the way that the company expected, not just due to these goodwill impairments. In the second quarter of 2025, Hey Dude revenue totaled to $190 million, and that was a decline of 3.9% year over year. So while DTC revenues for the brand increased slightly, wholesale revenues were down a whopping 12.4% year over year. Hopefully, with the new CFO in place and these Hey Dude impairments past them, the company can turn its financial situation around and return to strong revenue growth. However, navigating the tariff environment will be difficult, and the projected 9 to 11% decline in revenue is going to be a hard hill to get over, especially in as uncertain times as these.
Indeed.
And that wraps up episode 34 of the Special Situations Report. What we've covered today is just a brief overview of the special situations landscape, so if you'd like to access a more comprehensive weekly overview of all event-driven activity, go ahead and visit our website, thespecialsituationsreport.com. for daily updates and alerts on the special situations world, as well as access to tools to help you identify opportunities such as the merger arbitrage tool, check out insidearbitrage.com.
And if you enjoyed this podcast, please take a moment to like and subscribe on whatever platform you may be listening on, and especially share it with your friends who are interested in special situations. Thank you.
We also wanted to provide a reminder that this podcast is for general informational and educational purposes only. The content does not constitute financial, investment, legal, or tax advice. We do not warrant the completeness or accuracy of the content or data provided in this podcast. Nothing discussed in this podcast should be interpreted as a recommendation to buy, sell, or hold any investment or security. Investing involves substantial risks, including the potential loss of principal. You should conduct your own research and due diligence before making any investment decisions.